Hello and welcome to the Mutual Fund Show on NDTV Profit. I'm your host, Neeraj Shah. As always, it aims to bring you actionable insights from the mutual fund industry, or it aims to bring you some thought processes into, or at least thought processes of experts, so that we can imbibe the best thought processes in our minds to make the best of the mutual fund investing. On the show today, we're joined by Parag Parikh, Chairman and CEO of PPFAS AMC, or PPFAS Mutual Fund. And it's a pleasure to have him, simply because almost every guest and every advisor who comes in and recommends a Flexi Cap fund has PPFAS Flexi Cap fund in their recommendation list. And Neil, that must make you a proud Chairman and CEO, but also the onus of responsibility of performing the way you guys have performed over the last so many years. Thanks so much for taking the time out and speaking to us today.
Thank you, Neeraj, for having me. Yeah, it feels really good, and it feels like we've come a long way, like the last 11 years, and it was not a very easy journey in the beginning, and obviously the last few years have been good, so quite happy with that.
Yeah, as you should. Neil, before I get to the conversation that we want to do, I'm throwing this out of the blue at you, but can I please ask you a question that comes up nowadays when we talk to experts who recommend, and then the conversation that comes in as a question is that PPFAS, for a history of years now, for a number of years, has performed on a fabulous XIRR returns. But the question that now comes to a lot of people's mind is that it was possible for the fund to perform so well because of, aside of course, all the practices that you guys have, also maybe because the size of the fund wasn't as large and you had a fairly large ability to invest into global companies. And now both of those, in some sense, are slightly different as opposed to what it was maybe 5 years ago, because the size of your fund is very large, and your global exposure, because of the restrictions that have been put in, cannot be maybe as much as it used to be. And please correct me if I'm wrong here. So what would you say to something like this?
Yeah, thanks, Neeraj, for that question. So just let me take the foreign investment first, and then we'll go to the size. We've been PMS. We had a portfolio management service, or a PMS, from 1996 to 2012. And that was an all India portfolio, So we've been used to having 100% Indian portfolio also. The reason we got into international stocks is not necessarily to get more returns, but to balance the portfolio and lower the risk of the portfolio. For example, you don't want to take country-specific risk. When you want to get some of the country-specific risk out of here, in the sense that if there's a demonetization event or a war event in India, at least some of the portfolio is safe, which is outside the country. So in that way, it reduces the risk of the portfolio. Also at that point, and even today, we feel that there are some opportunities where there are no equivalent companies in India. So if you want to buy a Google or an Amazon or a Microsoft or a Facebook, there are no equivalent in India, so you have to look outside the borders for that. So surely the international exposure has come down from 30% to 14%. 14 odd percent is since the 7 billion market, the cap has been hit, and we are not allowed to send more money abroad. But our experience is also on to manage 100% Indian equity. So I don't think that's a really big deal. The way we look at stocks is the same. If it's global stocks or Indian stocks, the way we value them, the way we look at them is the same. So I don't think that's too much of a thing. Obviously, we hope the restrictions are lifted and we can again get back to investing some of that money into global stocks if valuations are attractive. So I don't think that's much to do with there. And on the size of the fund, look, our size looks big because we manage like pretty much one equity scheme. I mean, there are two equity schemes, the Flexi Cap and the Tax Saver. But essentially the Flexi Cap fund is the biggest one, and it's quite large. So it looks large because we're managing only one scheme, but all the restrictions on the cap on how much stocks you can buy, about up to 10% is at a AUM level, not at a scheme level. So if you were running, say, 15 or 20 schemes, and we liked one stock, it had to be divided across all those schemes. So that's why it looks big. So here we can do everything within this one fund. So our best ideas are not very diluted. One. Number two, as long as the market continues to grow and gets deeper, and we grow at the same pace, I don't think there's anything to worry about in terms of size. Well, there's only one thing that changes with a bigger size, obviously, is some of the flexibility of investing in smaller cap stocks and taking reasonable exposure to those. So for that, I think what we had said earlier is that we'll have about 25 to 30 stocks in the portfolio. That's a comfort level. But because the size of the fund, and that because we can't take meaningful exposure to small cap stocks in the portfolio, we'll have a longer tail. We'll probably get more small cap stocks, but with a smaller percentage. So I think if anything changes, that what will change. We have a slightly longer tail.
Neil, would you believe that having a larger size is a disadvantage? Don't say a no just because you have a larger size. I'm really trying to ask you an academic question. Would a scheme having a very large size be at a small disadvantage versus a fund with a smaller size, precisely because of the reason that you mentioned, that the ability to take larger exposures to smaller stocks becomes a bit constrained?
Yes, definitely. The flexibility definitely for the smaller cap stocks go down, but but we can actually invest pretty reasonably in the large cap and the mid cap space. And obviously, if the foreign limits increase to about to where they were, we can go up to 35% there. So again, does a small cap would be around 15-20% at max of the portfolio, no, on the higher side. So on that, only on the small cap, I feel there'll be a little less flexibility, and we'll have to get more stocks. Other than that, I don't think there's any other difference as such.
Been a thought in the minds of the AMC to launch a small cap fund? Is there been? I mean, just trying to think out loud.
No, there's no. We don't have any immediate plans of launching any other fund actually right now. So we prefer a diversified strategy. I think if there are opportunities, again, the flexibility should be with the fund manager. Wherever there are opportunities, he can go there. It should be I think the way we look at it is like a Swiss Army knife, right? It's one device with multi-functionality, and that's exactly how we look at our fund. And we thought that we want to take the confusion out of the investor. So you give the money to the fund manager, and if wherever there are opportunities, we can go there and get those opportunities, in whichever market cap or outside the country also. So it's a one-stop shop kind of a thing, and that's kind of the way we like to run in a diversified kind of a strategy.
Okay. Neil, generally, and maybe in your case specifically too, but generally, how would you explain the strategy to hold large amounts of cash? The opinion out here is divided firmly. For some fund managers, their call is that we are not given the mandate to hold cash, we are given the mandate to be fully invested. And in some cases, people say that why shouldn't I take the advantage of making a tactical call? Both arguments could hold true. My question is largely around the size of the cash that a fund house or an AMC builds out. How do you explain that strategy?
Yeah. So the preference for us is also to be almost fully invested. And for us, being fully invested is about 97-98% invested. We'll always have 2-3% cash for meeting redemptions or for those purposes. Again, we don't force ourselves to invest, and we don't chase stocks if the valuations are not attractive to us. Again, if there are no opportunities, then we are happy to hold some cash and deploy when the time is right. We are okay to have some short-term underperformance during frothy times, but I think the main thing is to protecting the downside is something that's very, very dear to us. I think we don't want big blow-ups in the fund or big negative drawdowns in the fund. And holding some cash when times are a little frothy makes sense for us. It's held us in good stead over the last 20 odd years, so I don't think we'll change that anytime soon. It also gives the fund manager the flexibility. He doesn't need to be under pressure to keep investing if there are no opportunities. So I think this has worked well for us, and we continue to do that. And again, having said today, we are having about 15% cash in the portfolio. So that means about 2 or 3 ideas. If you get 2 or 3 ideas and have 4-5% allocation to those ideas, then the cash is kind of done. So it's just a matter of that. We don't have cash position for the sake of having cash position. Oh, if the market is this high, then we'll have this percent of cash, or on some PE levels or something like that. It's a residual position if there are no opportunities there, and we're not in a hurry to deploy things if there are if sometimes they are frothy.
Okay. The other question would be the leeway that should typically be available to a fund manager to deviate from either the framework set by the fund house or the performance of the peer set. Typically, I mean, because people tend to sort fund houses by the returns that they've given in a year, the comparison would eventually end up happening with the better performing or the best performing funds. How much leeway should a fund manager have?
Yeah, so let me just start with the 4 or 5 things that are important for us when we invest in a stock, or the framework, or the framework that we use. One is that we want to partner with good promoters or minority-friendly promoters. We're partnering them for a longer time, and they need to have that track record for that. So that's the key thing is honest management. Secondly, we want to partner with businesses and not just merely purchasing stock, just a stock that'll go up or down, so we're not trading, we're investing it for a long term, for a long time. And for that, we need to see if the future performance of the future business prospects are good, the return ratios have been good. So those are the things that are important to us. Secondly, thirdly, our preference is for cash rich and low debt businesses. We've seen in downturns, the cash rich companies can really make acquisitions and really ride the storm and actually grow. So we like cash rich companies. Fourthly, some competitive advantage or a moat is important, because that will give it pricing power. If a company doesn't have pricing power, I don't think there's much money to be made in those stocks. So we prefer companies which have good pricing power, and that only happens if the competition is less in that space. And lastly, they have to be available at a good valuation, a good decent valuation that we feel is right. So on your question, the leeway part of it, so let me just give a bit of a cricketing analogy for that. So a captain or a coach doesn't tell Virat Kohli how to bat. They tell him to go out there, express himself, bat with freedom without any added pressure. So that's one thing. So for similarly for us, when we are telling investors to stay invested for 5+ years, and then we are kind of gauging performance of the fund or the fund managers on a short period, that doesn't work right. So I don't want to give them short-term pressures on performance as such. We also, if you're telling investors to be invested for a longer term, the fund managers also should get that much time to perform. I think that gives clarity to everyone. I mean, I think having a shared vision for the fund between the management, the fund managers, senior people, it gives clarity to people. They can do their job in an effective way without any extra pressures or confusion. And that's exactly why the cash position is also helpful. I mean, if we are going to be wanting to be number one in every 3 months, 6 months, 1 year kind of performance, then you will probably take excessive risk, and you'll probably not make logical decisions. So sometimes the logical decisions to just hold some cash if the opportunities are not there, and we are optimizing for the longer term. We're not trying to maximize for the shorter terms, and that's our strategy. And I think being on the same page with the fund managers really helps us, and that's how we do it. It's just having a shared vision, a shared value system, and a shared philosophy of managing funds. And I think that I think will more or less work for us, over the longer term if we're able to do that.
Well, your long-term investors thus far are certainly very happy with what you've done, Neil. I hope you can keep up the good work for a really long period of time. But thank you so much for taking the time out and being with us and talking to us about this. This is much appreciated, Neil, but simply because, as I said, almost every second advisor who comes in has a thing or two to say about PPFAS when it comes to portfolio construction, the PPFAS Flexi Cap Fund in particular. So it's great to get your thoughts out here. Thanks for the time.
Thank you, Neeraj. Appreciate it. Thank you.
Not at all. Well, time to slip into a quick break. In fact, wrap it up on this leg of the MF show. But earnings conversations continue. Sanjay Kirloskar, CMD of Kirloskar Brothers, joins us on the other side.